Good morning, everyone. Thanks for joining the weekly research morning call. Today we have some stock counter updates such as UOB, SIA, SATS, Thomson Medical, Starhub, and some feet on the ground like Seatrium, Wilmar, and the Euro Technical Pulse and Singapore Weekly. Yeah, so without further ado, I'll begin the SIA result. Yeah, so SIA released their third quarter 25 result last week, and top line is in line with our expectation, but net profit for third quarter 25 surged by 13% year-on-year as SIA recorded a one-off 1 billion non-cash accounting gain from completion of the Air India merger. Adjusted PAT may outperform our forecast due to a seasonally stronger third quarter. Yeah, and this is especially along with the decline in net fuel cost. And something positive about SIA is their SIA and Scoot recorded highest quarterly passenger of 10.2 million on the back of the seasonally strong demand, resulting to a 1.7% year-on-year growth rate. And meanwhile, the growth rate for third quarter 25 cargo loaded also surpassed capacity by around 2%, on the back of the robust e-commerce demand and also a step up in freighter charter and also a spillover demand from the Red Sea conflict, which redirected those like time sensitive and also perishable products to the air freight. And we also expect a seasonally softer fourth quarter ahead, as the passenger demand in January to March is usually like softer, alongside the muted cargo demand during Chinese New Year period. So this year is from January to February, yeah, due to the closure of the factories. And some negatives about SIA is the passenger yield decreased by 4.5% year-on-year, to around 10.7 cents per kilometer in third quarter 25, as airlines still ramping up their capacity aggressively. But despite various promotions, the group passenger load factor fall by 1 percentage point to 87.2%, since the 7.2% growth in passenger traffic fall short of capacity growth of 8.5%. And third quarter 25 revenue for the low-cost carrier, which is good, declined by more than 50% year-on-year due to the capacity reduction. But we do expect the full year capacity to remain comparable to last year's level. Yeah, so which is FY24. And SIA also indicates that the inbound travel demand from China remain robust, but the outbound demand is relatively soft, and Chinese passengers still contributing to around 30% of the group's total revenue. Yeah, for the low cost carrier. And for the low cost carriers, contributing to around 20%. And we expect Chinese demand to recover gradually from the upcoming year. And for fourth quarter 25, passenger and cargo yield may continue to decline, but the magnitude of the drop is less likely to be severe as compared to the first half 25. Given like the magnitude of the airlines ramping up their capacity is like a slower pace. We do upgrade SIA to a neutral with a higher target price of $5.74 based on the 1.1 times price to book. Previously was using one times PB. This is driven by two reasons. Firstly is SIA's normalized ROE is around 13.8%, which is significantly higher than the 10-year average of 5.2%, and also higher than the pre-COVID level of 5.4%. And secondly is we do anticipate a higher dividend payout ratio for SIA. Yeah, so last year, for the last 2 years was around 52 to 53%, and this year we're anticipating around 55 to 54%. Yeah, so this will translate into a 28 cents DPS. And the reason is that SIA is having a very strong cash position of around 8.3 billion, which is significantly higher than the historical average of around like 4 to 5 billion. Yeah. So we did upgrade it SIA. And moving on to SATS, they released the third quarter 25 result last week, and the results are in line with our expectation. SATS set an additional bonus provision in third quarter 25 on the back of the exceptional result, which resulted in a higher operating expense. But the normalized EBITDA, if we strip out the additional bonus provision, will be around 9.2%, compared to with the additional bonus provision is around 6.2%. And something positive about SATS is their gateway service revenue grew by 11% year-on-year, primarily driven by a 15% increase in air cargo tonnage. And inventory front loading in third quarter 25 was even more pronounced as Trump's tariff policy was like well anticipated by the government. And however, SATS do note that the fourth quarter is usually typically like seasonally weaker due to again the closure of Chinese New Year for the factories for celebration. And finance costs for SATS is expected to continue to trend down, and we are looking at 50 to 100 basis point saving from their November 25 refinancing. And something negative is the specific Asia customers are considering potential contract cancellation, even though like none of the cancellation has materialized yet. And SATS also has observing increased cargo shipments to Middle East rather than particularly to the Saudi Arabia side rather than to the US. And at the same time, European is also experiencing a rising volume, yeah, from their cargo volume. And SATS is also actively collaborating with their customers to set up additional stations to capture the emerging shift in global cargo demand. And with US cargo handling services contributing to around 25% of the group's total profit, we are forecasting around like the worst case scenario will be around 20% reduction in cargo demand in the upcoming financial year, which is FY26. Yeah, and for outlook, even though like the prohibition on the de minimis entry for Chinese good was suspended, it still remains the downside risk for SATS. Yeah, since the customers is shipping the supply chain outside of China, and the exemption of the de minimis rule is expected to reshape global shipping patterns. Like for instance, Temu, they has begun to stocking inventory in the US, which is signaling a broader shift among e-commerce businesses toward the ocean freight, instead of the air freight. Yeah, however, SATS is proactively implementing mitigation strategies, including like consolidating customer unit costs and also exploring alternative routes to bypass the tariff. Yeah, so we do maintain our FY25 estimates as the impact on US as the impact of US tariff on SATS bottom line is expected to be minimal, with only 2 financial months affected. Yeah, but we do cut our FY26 PATMI forecast by around 9%. Yeah, given the cargo handling segment for the US part is contributing to around 25% of the SATS group total revenue. Yeah, so we still maintain a buy call for SATS with a lower TP of $4.34. Yeah, so moving on to Seatrium, this is a Phillip on the ground. We don't cover Seatrium. Yeah, so they have a market cap of 8.5 billion. So they are mainly doing oil and gas and also renewable vessel builders. And especially ship repairment part, which is a bright spot for this second half 24. Yeah, and for their second half 24 financials, underlying earnings recovered, but the margin is still disappointed, is around 1.6%. And the margin was burdened by the provision of some contracts on the legacy US contract. Yeah, and we do expect a S-curve recovery on the margins. And their order book jumped by 43% to 23 billion in FY24. Yeah, which is around 2 years plus of their order book. And for 2028 target, Seatrium is looking at a 1 billion EBITDA and also ROE to be more than 8%, which is implying a net profit of around 640 million PATMI. Yeah, and all 13% PE in the next 4 years. And for the rig segment, there is no meaningful renewal of the jackup in the near term, because of the lack of financing on the non-NOC segment. And what we believe is the stock is trading at a historical PE of around 42 times, which is very much overvalued or is pretty much high. And yeah, the only interesting part for Seatrium is their repairment segment, where the volume rose by around like 6 million per vessel in the second half 24, compared to the first half is only around 3.9 million per vessel. Yeah, and they did pay a final dividend of 1.5 cents. Yeah, that's all for Seatrium. I'll hand over to Zing for technical parts. Thank you.
Thanks, Melvia. Good morning, everyone. I'll move on to the technicals. So first up, looking at S&P 500 last week, for the full week itself, it was down 1.66%. Price was holding up pretty well above 6,100 until Thursday. However, on Friday, there was a sell down and price broke below this trend line and the 6,100 level. So I think with that, with the recent closing of the week of last week, we're likely to see some further pullback hit for this week. Perhaps back to the previous support levels around 5,920 to 5,980 area. Current resistance is likely at 6,060 to 6,100. Next slide, please. Next one, we have a technical buy for capital investment at $2.54. Take profit levels at $2.68 and $2.79 respectively, with a stop loss at $2.46. Last close was $2.45 on Friday. So looking in terms of the chart, price broke out of a downtrend channel highlighted in blue, which it was trading in since November of last year. And also recently there was a Bollinger Band squeeze, which could suggest a period of low volatility, which is usually succeeded with a period of high volatility, which supports the price to actually perhaps break out the current downtrend it was in. Also, MACD was also showing a bullish divergence signal and increasing momentum where it formed a higher low despite price forming a lower low and during the consolidation phase in January this year. Next slide. Yeah, so for the summary of our trades initiated last week for Cole Brothers Eco Engineering, it hit our first take profit level at 0.048. Currently, it's flat as of Friday. As for Pacific Radiance, it's currently still in progress. It's down 5.8%. For capital investment, I mentioned earlier, it hit our stop loss, so it's down 3.15%. So that's all from me. I'll hand over time to Glenn to talk about UOB results. Thanks.
Thanks, Zain. Yeah. So for UOB's results, they released their fourth quarter and full year earnings. As our title suggests, it says higher allowances, effort earnings. So allowances were really the thing that lowered their PATMI for the quarter. So for fourth quarter adjusted earnings, it was slightly below our estimates from the lower than expected fee income as well as the higher provisions that I mentioned earlier. Full year adjusted PATMI was at 97% of our forecast. For the dividends wise, it was the final dividend for the year. It was up 8% to 85 cents. Full year, it was up 6% to $1.80. They also did announce this $3 billion capital distribution package, which includes a 50 cents special dividend in FY25 as well as a $2 billion share buyback over 3 years. So I'll go more into detail for this capital distribution package later. Just jumping straight to the positives, if you look at the first positive, there isn't really many positives, but you can see that the net interest income did inch up by 2%, mainly from the loans growth of 5% year on year. However, their net interest margins has continued to contract. It was down to 2% for the fourth quarter. And this is to be expected as the interest rates continue to decline. Looking at the January's exit NIM, it was at around 2%. So UOB is also expecting for the NIM to maintain at the current levels for the rest of 2025. But we also expect them to maintain this net interest margin of 2% as they continue to manage down their cost of funds. So they are able to lower, their fixed deposit costs and their CASA costs. So this will continue to lower their cost of funds, and together with the top line also being lowered, so they can maintain this 2% moving forward. For wealth management wise, it has continued to grow. It was up 18% year on year, mainly due to the recovery in lending activities as well as improved market sentiment. The AUM also was up by 8% year on year to 190 billion. But overall, you look at fee income, it was flat because the other fee segments that make up fee income were quite muted. So hence, you look at fee income, and in total, if you look at the other non-interest income, it was also quite flat. For the negatives, and I think this is the largest negative and really put down earnings, was that their total allowances had grew by 5% year on year, and this came from higher specific provisions. This increase in specific provisions was from two US commercial real estate accounts, mainly due to an unexpected drop in their property valuations, and also the UOB deemed them unable to continue repaying. So the interesting thing was that these accounts have not yet defaulted, but I think UOB did some of their calculations and realized that okay, they may not be able to pay. So before this, they were shifted to general provisions, but then now they are shifted again in this quarter to specific provisions because they believe that they cannot sustain the payments. But look at total credit costs, it was quite stable at 25 basis points as UOB wrote back higher general provisions to offset these higher specific provisions. So net it was only a slight increase of 5%, but still enough again to to hurt their earnings because the other segments didn't really grow as much. Looking forward at the outlook, FY25 guidance, it was for higher total income, so no specific figures, from high single-digit loans growth as well as double-digit fee growth. And cost to income ratio will be normalized at around the 42% range, with credit costs coming in around 25 to 30 basis points. So with all this said, we are expecting the FY25 earnings will grow by 12% year on year from more substantial fee trading income as well as loans growth. And while the net interest income as well as net interest margins remain stable. And we're also expecting that credit costs will come in around the upper end of their guidance of 25 to 30 basis, so around 30 basis points. And the higher volatility from the Trump administration could also bolster their trading income growth in FY25. For capital distribution, so they did announce this new capital distribution strategy that will span over the next 3 years, meaning 2025 to 2027, and it includes a 800 million or $0.8 billion payout in the form of 50 cents per share. So it's like a bit of a special dividend in FY25, and as well as a $2 billion share buyback program, which will be completed over the next 3 years. So this share buyback program is quite significant because they haven't done share buyback in this way, in terms of the ordinary shares for the last, I think they haven't done it. The last time they did it was in 2004. Yep. So almost 20 odd years they have not done this kind of share buyback. So it's quite a positive sign and a significant milestone for UOB. And if you based on a dividend payout ratio of being maintained at 50%, this capital distribution would increase we estimate it will increase their DPS for FY25 to $2.50. So this indicates a 32% increase year on year. And this DPS of 250 includes the 50 cents. So we are expecting in 2025 there will be a $2 normal dividend as well as this 50 cent special dividend. And the $2 billion share buyback would reduce their fully phased-in CET1 by 80 basis points when completed. So what does this mean? It means that even after completing all this $3 billion capital distribution, their CET1 will still be above their optimal operating range. And in order to reach this optimal range, we believe that UOB can continue to pay out this special dividend of 50 cents per share for at least 2 more years, as the retained earnings that they earn, if they continue to be profitable, will continue to prop up the CET1. So we believe that they can continue to pay out a higher dividends moving forward into the next 2 years, so in 2026 and 2027. We do maintain and accumulate with a higher target price of $41.80 as we roll over our valuations. Yeah, so that's for UOB. Now let me move on to the banking monthly. Yeah, so for banking monthly, we first start off again with the interest rates. It was not really unexpected. So the interest rates were all down. Singapore interest rates were down by 19 basis points to 2.95%. And this is the lowest that it has been since November of 2022. Year-on-year wise, it fell by 74 basis points. And this is the most significant year-on-year decline since January of 2021. And we do expect that this Singapore interest rates will continue to decline as more Fed rates come in. If you look at the Hong Kong interest rates, the HIBOR, the blue line here, it's a bit more volatile. But if you look at the general trend, right, it's also going down in line with the Fed rates. So for the 3-month HIBOR, it was down 36 basis points month-on-month to 3.99%, and year-on-year it was down 83 basis points. So we also expect the HIBOR will trend downwards following the Fed rate cuts. Now moving on to loans growth. Yeah, for loans growth, it's quite positive, very, very positive. We finally see it, surpass this 5%. So it finally hit the mid-single digit mark in December. It was at 5.2% year-on-year growth. And this is a 27-month high and also an increase from the previous month's growth of 3.3%. It has surpassed our low single-digit growth estimate for 2024. For 2025, we expect it to be at these levels of around mid-single-digit loans growth, as it's expected to recover further from more rate cuts going into the rest of the year. And the banks are also guiding, similarly mid-single-digit to high single-digit for some of the banks. But if you average it out, I think you'll be looking at around this maybe high middle kind of single-digit loans growth for 2025. For the segments wise, look at business loans, it was up 6.2%. The building and construction segment, which is the single largest business segment, also was quite positive at around 4%. And however, the manufacturing segment was still down by 4%. For consumer loans, it was also sort of a very healthy increase. It was up for the 12th consecutive year-on-year increase. And the housing loans also quite stable at around 2.8%. As for the total deposits and balances, it grew by 7% year-on-year, but the current account and savings accounts proportion was still quite unchanged. It's still around this 18-point-something%. So for December, it was 18.6%. We expect that the CASA ratio, will increase as the higher interest fixed deposits mature and funds get shifted back to CASA. So all these fixed deposits, other sort of low interest deposits will move back to CASA because the interest rates aren't as attractive as it was previously. Moving on to the SGX statistics. Yeah, so SGX, the monthly statistics for January was positive. We have seen both the securities as well as the derivatives volumes growth continue into January. For the SDAV, it was up 11%. SDAV is the securities daily average value. It was up 11% year-on-year. And the DDAV, which is the derivatives daily average volume, grew by 9% year-on-year. So both of these have continued to grow from the previous half, right? So we expect that the heightened volatility surrounding the Trump administration will continue to bolster the volumes, and this will benefit SGX. The VIX, which is the market index that measures the implied volatility of the S&P 500, was also a bit higher at 16.8 compared to December's 15.9. As for the top 4 equity index futures turnover, however, it was down by 12% year-on-year, mainly due to the lower Nikkei 225 index futures, as well as the FTSE Taiwan index futures. Yeah, so as I mentioned earlier, we expect that this will be beneficial for SGX, as they really, the majority of their revenue comes from the volumes of, SDAV as well as DDAV. And they had a very good first half FY25, last half, because of the volume recovery that we saw in that half. So moving forward into they call it second half FY25, we expect that the heightened volatility will continue to bolster their volumes, and the January is quite a good indicator of where we are heading to for the next half of the year. Now moving on to the next slide. Yeah, we're looking at the Singapore's banks performance. So for January, it was the share price performance for the 3 local banks were quite muted. It only rose by around 3%. So this is really not very impressive. And we believe that this muted performance was really due to investors waiting on the sidelines, before the fourth quarter results were announced. And also, apart from the results, they were also waiting to see what form of capital they were, or how would they give back capital and how much they'll give back. So far we have seen DBS and UOB, release their results, and also give back the capital and their strategy in giving back the capital distribution. So we're only left with OCBC, which will be on Wednesday. Now, moving on to the next slide. Yeah, my last slide. Yep. So we do maintain overweight on the Singapore banks, and with the lower rate cut expectations going into this year, the rest of the year, as well as a rising yield curve, the banks can earn more interest on loans than deposits, and this would boost their net interest income as well as their net interest margins, or at least maintain it, keep it stable. And with the rise in trading volumes, the capital markets have become more buoyant for the fourth quarter, and the bank's trading income could be further benefited in the rest of the year for FY25. So the continued double-digit growth in fee income as well as the loans growth recovery will boost their earnings. We also believe that there's further upside to dividends as the banks look to manage their excess capital actively, as well as the share buybacks, which will both improve ROE as well as their EPS. So that's all I have for the banks. Now, because Paul is currently stuck in results briefing, so I'll be covering him for his slides. He has quite a few. I first start off with Thomson Medical. So for Thomson Medical, the results were definitely below our expectations. It came in at around like 32% of our full year forecast. And the main negative, if you look at the main negative, it was the red bar, the red box at the bottom here. There was a 90% collapse in the earnings in Malaysia. And what happened is that because across Malaysia, some of the insurers are exiting. So they used to have two insurers in Malaysia, three in Malaysia, and then two exited because when you're left with one, they would just, the insurer would, they don't really have much competition. So they will ask for a very steep discount. And I think the discount that they're asking for is almost 30%. So when you're looking at that kind of discount and they're giving this 30% discount, they're virtually not making any money from taking on insurance payments. And it's not that the patient cannot get insurance, it just means that the insurance on the panel is quite cashless, so it's almost like it makes up almost like 70% of all the patient flows. For the positive wise, there's been a sign of recovery in Singapore because previously they were having some renovation and there was a bit of a disruption. And however, the volumes have started to pick up, as the renovations get completed. For our outlook and recommendation, we lower our revenue by 12% in the EBITDA, and our target price is also lowered, so we cut it to, now we are having a neutral recommendation and a target price of $0.048. So we believe that moving forward, Singapore will start to slowly recover because they're starting to include oncology. It's a cancer treatment into Malaysia and Singapore, and it's something that they never did before. And of course, that will generate higher volume and of course higher pricing as well. And in Malaysia, they're also starting to reduce the discount because it's not sustainable, and they're trying to get back one more insurer into the panel. So instead of one, now they'll have two. And for Singapore, the inpatient volume post renovation, there's not really a very big rebound. So in the second half, it'll be quite weak because Vietnam is also moving sideways for them, and it's burdened by the high interest that they're facing. And if you look at Vietnam on the left here, the table, after buying Vietnam, the interest expense did spike up by 50%. So their vision is also facing some issues on extreme competition, and they have to increase their marketing expense in order to beef up the revenues wise. So now moving on to the next slide. Yep. So for Starhub, the title is Mobile Competition Clouds the Outlook. So most of the earnings were generally largely in line. Most of the earnings were generally largely in line, but their EBITDA was slightly below at 96%. And the main positive has really been a turnaround in their cybersecurity. But even with a $400 million profit for their cyber business, they only have made around 600,000. So we're not really sure what kind of margins that they're working on. And Also, those positives at the same time, they are it's sort of a negative because they're turning around some losses from the last year. And if you look at the negatives wise, if the negative is for mobile or even for the whole of Singapore mobile, there's very intense competition. So if you look at the left, the revenue wise, it's down by around 5-6%, 6%, sorry, for the mobile. And they are continuing to the thing about Starhub is that they are saying that they are winning market share, but you not really know whether they are winning it or they are really buying the market share because their mobile revenue is declining and their ARPU is also collapsed by around 12%. So what you are selling is, the selling price is dropped by 12%. You're not really winning market share if you're just cutting your costs, your price in order to gain that market share because net your revenue is actually still down. So it's really more like subsidizing the cost so that you can beat the competition. So the competition is quite intense and they have not actually given any revenue guidance. They just said they are not able to give revenue guidance because the competition is so intensive. And we have lowered our EBITDA mainly due to the competition, and we have also kept our target, but we have maintained our target price at $1.29, and our accumulate recommendation is also unchanged. I think the biggest news is that they are doing the acquisition, but the rumor now is that they are shifting now to maybe TPG or Simba that could be the one that acquires M1. So if this happens, it could be quite positive for Starhub because whoever is the courier that will suffer the most is usually the one that you are acquiring, and you will be, because once you acquire this a company, you will be very distracted with the acquisition, and you also incur a lot of one-off costs. And with that, you have to remove stuff, you have to write off stuff, equipment, and so on. So we believe that the acquirer, if it's TPG, it will be quite beneficial for Starhub. Now let's move on to the next slide. Yep, this is venture. So as the title suggests, the near term is going to be softer in the near term, and the results were below expectations with revenue and PATMI at 96% of our forecast. The main positive is that they are still continuing to spew out a lot of cash. They're generating cash of around 400 over 1 million, 400, yeah, over 400 million, sorry. And although the net profit is around 200 for the full year net profit, the dividends is still quite stable at around 75 cents, and it's actually a very generous payout. So they are paying like 90% dividend payout. And the negative is really just the limited growth drivers. And for their guidance wise, they have always been quite cryptic in their guidance. So they use their guidance outlook is mainly to guide the whole market. And for the short term business, it's deemed quite uncertain. That's their exact words. So they don't. I think the two things that are hampering them right now is that their customers are turning more cautious because of the tariff uncertainty. So nobody knows really how much the tariff is going to be imposed, and a lot of the customers are just being cautious and holding back on their orders. And for the second reason, which is a bit more unique to venture, because they are quite big in things like Illumia, is that I think the minister did mention that one of venture's customers is Illumia. So when they are basically, when the Trump proposed cuts in the National Institute of Health, the healthcare and all the labs and the universities are also going to face cuts in their budget. So as a result, they are going to they're going to have less money to buy equipment. So they're going to buy less equipment, and this is going to hurt venture because Illumia is one of their big customers. And since that they are since this was actually mentioned by the minister, we are able to say it publicly, and we do lower our revenue as well as our PATMI by 12 and 10% respectively. But we are keeping our neutral because the yield is at almost 6%. Just in the near term, don't expect any strong earnings from a venture. We do lower our target price to $11.80. Now moving on to the next slide. Yep, so we are now heading to the Singapore Weekly. Yeah, it's not that we don't really have a lot of we didn't keep everything blank, just that the US there was really no news to update, so we just there's not really anything there. But for the Singapore news, it's that the property news, property has come in very strong. It's quite positive. In January, it was up almost 3 times, 256%. It's a very big start, and I think the main project that everyone is talking about is the Ori Toa Payoh, which is it was launched at $2,700 per square foot. and almost 86% units were sold. So it's almost considered 90% sold in one weekend. That's almost considered fully sold. And I think the feedback that we got from some developers is that the reason why there's so much interest and demand is because there's a lack of new launches in the area. And if you look, but then again, you speak to some other developers, is that although the price is high, the buyers are really looking at the absolute price. So they're not looking at the per square foot, but they're looking at if it's below 2 million per se, then they will be more interested, because it's sort of like a sweet spot for investors and for future homeowners. Now moving on to the next slide. So this week, there were two strategy reports that were out. The first one being the budget, and the second one is the equities market review. So the review, the most important thing is that the headline figure, is that they are deploying 5 billion, right? And it goes into some family office, but we're not really sure how much of this 5 billion is going to family office. So if you compute that, the whole excuse me, for the whole total market cap is quite small. If you put this 5 billion into the whole SGX, right? The STI, sorry, it's quite small because the entire market cap of stocks listed on the SGX. The number you get from SGX is around 800 billion. That includes ETFs and so on and so forth. But if you take the stocks itself, this makes up around 1% of just the equities itself. But if you only take the small and mid cap, and I think that's one of the mandates required, is that they must invest in non-index stocks. So if you use the 1 billion and below, so you're taking small and mid cap stocks, 1 billion and below, the pool of money is actually very significant. So if you look at that on the small mid cap stock, it makes up 8% of the total amount. So we don't expect that, of course, the whole 5 billion will be in this in the small and mid cap. But I think that the thing is that you can't really have this full 5 billion into Singapore because it's not very commercial. So most likely those who propose want this to be also in the ASEAN mandate. It means that you would have the ASEAN equity mandate, but some of it or a substantial part of it will go to Singapore. Let's say if you assume around 30%, it'll still be a very significant 6% of the small and mid cap. So 30% of 5 billion, that's what I'm trying to say. And I guess if you look at the Singapore budget now, we're moving on. It's usually not very impactful, but of course there are some near-term sector beneficiaries, and that would be the retail market. Because in total, the SG60 budget, I think almost 2 billion will be given out to citizens. Yeah, it's around $600 to $800 per person, and this will benefit this sector. The construction also will remain as a good beneficiary because there's a top-up, for all these construction projects like the coastal flood protection and the Changi Airport. So this will total also another, this will actually benefit them quite a lot. And last but not least, the defense spending will also benefit because, the defense spending is rising by 12% for FY25. In 2024, it was only up 8%. And moving on so that's all for the budget. Now moving on to the events that we're going to watch. For 26th Feb, which is the Wednesday, there's NVIDIA results as well as OCBC, so the last of the Singapore banks. We do really have a lot of results for the rest of the week, and I think most of them are Paul's one. Yeah, for the Corporate Insights webinar for this week, we have Prime REIT as well as iREIT Global on 25th Feb, which is tomorrow, as well as 27th Feb for iREIT Global. So you can just join our Corporate Insights webinars moving forward. Okay, now moving on to the next slide. Yeah. So this graph is just showing the big spike in home sales. So for home sales, you can see the total transactions, and that's quite positive as well. But secondary as well as new have also been up. If you look at the inventory levels for property developers, there's also a big spike, and but on a whole, it's actually quite stable. It's on the right chart here, the red line. That's the inventory levels. So the red bar, why is there this huge swing? It's basically inventory to sales. So it means how many years it will take for you to sell the inventory right now. It's generally quite stable at average levels of around 2.8, which is the red line. And the blue bar means the unit outstanding. So there's around 16,000 units available for sale, which is also quite stable. So it's not really rising or spiking strongly. Now moving on to the next slide. Yeah, so this is there's a sort of a chart or a table, sorry, on those who want to understand the budget a bit more. It's not really going to impact the market, it's not going to make you richer. I mean, apart from getting that $600 to $800, but it's really just to understand a bit more of how they get to their surplus and their deficit figures. So the top line, the revenue did well, right? If you look at the operating revenue, it was up 13% year on year, and mainly because of the GST, and so all of us did contribute to this increase in revenue. The GST income tax was also higher. It was up by 24%, so this also contributed to their revenues. I think the one that you want to watch out for as an investor, I think I mentioned a bit earlier, was the defense spending. So, defense would really benefit SD Engineering, as most of it goes to SD Engineering, and it'll be a good foundation for their revenue because the government spending more, so it will just flow straight to SD Engineering's revenue. For construction wise, it's basically for transport wise, it's basically construction spending in a way, because it's spending on the MRT lines, and that's where you get that increase in that transport in construction, sorry. And now we look at the top-ups, less the special transfers top-up. So this is where you get all your sort of the payouts, right? So they give out a lot of special top-ups, but like your GST voucher, and all those different kind of vouchers that they give, the CDC voucher. So that was around so that's around 2 billion, and they'll top up all the different various funds. It sort of helps to balance out the whole balance sheet. I think, so Wilmar. Okay, now we're moving on to the next slide. Hold on, sorry, give me a minute. Yes, so for Wilmar wise, give me a minute, sorry, let me just. So for Wilmar, their financials were down 23% for the second half, and this is excluding that they have a $231 million gain. For sugar, it did hurt them because the lower sugar price as well as the Australia strike did hurt their margins, and it really contributed to their revenue decline. For refining, it was really quite stable. Refining margins were relatively unchanged. As for palm oil, the price was healthy mainly due to the B40 biodiesel mandate. And for China consumer, volume was improving, but we did not see any margin expansion. Last but not least, for the Trump policies, it would make the soybeans cheaper, and China can now source from South American companies compared to a few years ago, and there's also less fierce shortages. So we do expect modest recovery in all the divisions, and for Wilmar. Now moving on to the next slide. Oh, yeah. So I think that's all for us. Now we just move on to the Q&A. Yeah, hopefully Paul can join back in later to get to answer some of the questions that you have. Yeah, maybe I'll start first since I'm here anyway. Just let me look through the questions to see which ones. What is the expected accretive on UOB forward earnings with the acquisition of Citi? So I think for UOB wise, it's already in they don't put it in anymore. So there's no separation because the last year is considered with Citi, considered with the Citi acquisition already. So it's quite hard to separate it out anymore, where you say that would there be an extra bump up because of Citi? Because now they report everything as a whole, right? They don't separate out how much does Citi provide, how much does the main UOB, because if I'm not wrong, if you go to Malaysia now, there's no more Citibank credit cards, right? It's all converted to UOB. So it's really very hard to say how much this would improve even their ROE for 2025. That's why I think the guidance or what we expect for fee income would be more, will be a better guide, right? So we're expecting double-digit fee income growth for 2025. What's my estimates for upcoming OCBC results? Any guess on share buybacks, special dividends as well? Yeah, for OCBC, I think they will maintain quite a good sort of growth for FY24 in total. Fourth quarter wise, I think it'll be quite stable. Share buyback, special dividend, it's really hard to say. They are the most, how do I put this? They are the most, they disclose the least among the three local banks. So previously in the third quarter, you can see, DBS said they will do something, 3 billion, right? In the third quarter, UOB also said they will do share buybacks. And then OCBC, when they don't say anything, and then when they ask, they're like, yeah, maybe we'll do something, right? But then again, if you look at OCBC, they have the highest excess capital. It's still, I think it's around 4 billion, yeah, for OCBC. So we are hoping that they will follow suit. I mean, if the other two banks have done something, and they are not, the only acquisition they're looking at is really GE. But even if you minus off GE, they still have a $2 billion excess capital. So they would have to give back something in order to reach their optimal CET1 operating range. Yeah, so I really don't have a guess on how much they'll give back. But if you look at the excess capital they have, which is around 4 billion, even if you minus off GE 2 billion, there's still an additional 2 billion. So you can take your best guess from there, 2 billion. I think it works out to around also around maybe 50 cents or 50 cents to $1 kind of payout, dividend payout, if they really reuse the whole thing. Yeah. So you can just work your sums out from there, from that 2 billion excess capital, how much they are willing to give back. But it will really be I think everybody will be surprised by whatever they do, because they don't do it, they don't say anything. Okay, at the current situation, which one of the three SG banks is a better investment as compared to the other two for long-time investment? That's an excellent question. Please elaborate your reasons behind it too. Long-time investment, I would say all three banks are good if you're looking at long. I mean, if you're looking at a long, like what will your long term be? I'm guessing long term is above 10 years, maybe. Yeah, so if you're looking at which is a better investment, I guess you will see how the banks will be growing. For DBS, at least for 2025, they're not having much earnings growth. So it's a pure dividend play, right? If you look at DBS, because of the tax of the global minimum tax, which will hurt them by around 400 million. So their net earnings won't really improve, right? But their dividends are very healthy. It's still hovering around, I think 6.6, 6.7% kind of dividend yield. And for the other two banks, OCBC haven't released their results yet. For UOB, I guess they are banking really on the growth in city acquisition. So they are boosting their fee income, and that's what is going to be growing for them. And also, their loans growth recovery is quite healthy. You're seeing it 5% for fourth quarter of 2024, and in 2025, you're expecting that it'll be higher than that. Yeah, so for longer term, I would say UOB will be a better. OCBC is yet to release the results, so maybe I can come back to you with a better summary of how of all three banks once OCBC release their results, as well as their outlook for 2025. Okay, let me just yeah, there's one more here on UOB. You mentioned UOB is negative for SIA allowance from US CRE. Does DBS and OCBC have such exposure? They do, but their exposure to US CRE is really very minimal. I think if it's not wrong, from last they announced was it's less than 5% of their total loan portfolio. So overall, both banks don't really have. And the main thing about the banks, Singapore banks, is that they do have a lot of general provisions overlay. So they call it management overlay. In a sense, they are anticipating, even for DBS, let's say if the specific provisions or specific allowance comes in too high, they can always offset some of these general provisions overlay, which they have been accumulating for the past for quite a number of years, and they can offset and write back general provisions to offset these specific provisions, and net their allowances will only increase slightly or not even increase at all. And if you look at it in a whole, their credit costs will not really be very far off from where they are guiding, right? So that's a good thing because they can sort of anticipate how much they can write back. And I think DBS did mention, they have around 2.1 billion worth of management overlay that they can use to offset higher specific provisions. UOB doesn't say so, but I'm guessing it's around that ballpark figure, or at least 1 or 2 billion. Yeah, I think I mentioned the one on OCBC. Yeah, any updates on the status of the GE saga? Not really. They don't really have any updates. But anyway, Wednesday I'll be meeting them. Let me ask and see if they have any updates. But then again, they'll probably just say that there's no update. So yeah. Another one for the banks. How will potential for higher for longer interest rates in 2025? Do you think this could be positive or negative for local banks' earnings? Yeah, definitely a positive, right? Higher for longer interest rates, and also I think the more important thing is the lower than expected rate cuts will be positive for the local banks' earnings because they can keep their margins up, but at the same time they can use the few rate cuts, then they will just lower their interest rates, which is what we have seen so far. We have seen all the banks lower their fixed deposit rates because they have too many fixed deposits. They've taken on too much and it's too expensive. And also like UOB, they did lower their flagship their current account interest rates because they said due to the rate cuts, so they have to lower their rates. But if you look at the top line growth, because rates have not really dropped as much, they are still maintaining it as a higher bit. So if you look at it net, right, which is why the margins are able to still maintain at these levels. And if margins are maintaining, loans growth have been healthy because there have been a recovery in the overall environment and in the overall, I guess, the sentiment. So, this will only be beneficial for the banks. Okay, let me see whether there's any more for me. What are the drivers for higher SDAV? Not really. It's really just the volatility. So it stands for Securities Daily Average Value. So as long as there's more action, there's more movement, then this will drive the higher SDAV. Yeah, it's not just mainly from the local banks. Yeah, it's just in general the whole market and environment. Yeah, so this is a good question. With 2025 budget announcement, to boost sorry, let me just find this question. Yeah, to boost local stock market with $5 billion, will this be positive for SGX and its stock price? Yeah, you would think that it would be positive, but if you look at how the market has reacted, the market has sort of reacted. When it first came out, it wasn't very positive, but after that, it did creep back up. So I think the thing that will be positive for SGX really is the volumes, right? The volume figures. So the market reacts to the this month. I mentioned earlier during my banking monthly presentation, the SGX market statistics, both the SDAV as well as the DDAV. Yeah, so those volume are good indicators of how SGX will be doing. Right, so we just have to wait and see if this budget announcement to boost the local stock market, whether it works. It can boost, if it does boost volumes, and then we'll see it coming in because we get to get these figures every month, and then we'll see whether the monthly volumes go up. And if the monthly volumes do go up, it means that this is working, their initiative is working, and then it will flow to SGX. Like it'll be positive for SGX's stock price. Yeah, I hope I explained that well enough. Okay, I think maybe I hand it over to the rest. Yeah, okay, there's one more last one, sorry. You said might as well OCBC might as well upgrade Eastern offer. Yeah, I think that's what a lot of the GE shareholders are also thinking. But I'm pretty sure they have to go through the board and directors, so it's not so easy to just up the offer. Yeah. Okay, I hand it over to the rest of my colleagues. Thanks.
Thanks, Glenn. Take some questions. For the first question, Pan United, record target price was set around $2. Is this derived when the counter is rather illiquid? Yeah. So just to clarify, our latest report on Pan United was last year August, and the target price was 0.68. So this target price is mainly driven by, mainly derived from how we forecast revenue and earnings. For revenue, it is driven by volume growth and how the ready-mix price changes. And for our revenue wise, we did forecast it to grow around 12% for this FY24. And then for our margins wise, we do expect the net profit margins to be around 4.8%. And yeah, so that is how the target price was derived. Hopefully it answers your question. Next question is what can we expect for STAC results tomorrow? I I'm not very optimistic about STAC because previous quarter the revenue dipped by around 19%, 19%. Big slowdown in oil growth. So I think for the upcoming results, we are not very optimistic. When we ask whether they have any analyst briefings, they are not going to have any analyst briefings for this quarter as well. Yeah, so next question is what do you make of Hong Leong Asia's Yuchai Vietnam strategic agreement? For Hong Leong Asia, just to give you some context, right now their revenue is around 80% in China, and around remaining 20% is in Malaysia and Singapore. I think the stock market was quite positive on this news because diversifying into Vietnam that means it will have more diversification in terms of its revenue segments. And I think Vietnam has been quite consistent in its GDP growth of above 5%. But I think beyond that, I don't have much to comment. And but I'll meet the management this Thursday. So I think next Monday's morning call, if you ask again, maybe I can provide you with a better context. Yeah. I think I'll hand over to my other colleagues for now. Yeah, thanks.
Thanks, Ip. I'll take some question. SATS had a good earnings result, but why the share price going to the other direction this morning? Your fundamental view. And also, there's another related question: why I lowered the target price even though the fundamentals was good? Yeah, so I just combined two of them. Undoubtedly, their third quarter results was very good, and but essentially, like third quarter alongside second quarter was because of the front loading, in the view of the tariff, which like the market has already been anticipated. And we do expect fourth quarter 25 to be muted, but mostly because of seasonality wise, Chinese factories was shut down for Chinese New Year celebration. Yeah, so the volume will be muted for fourth quarter. And for the 2026 onwards, we generally lower the target price because of the unclear outlook. Yeah, so it remains a downside risk. Like even though like US just canceled the cancellation of the exemption of the de minimis, which means like they're actually exempting the tariff from the good, which is under 800 US dollar. Yeah, but this is only till further notice, and the e-commerce like warehouse and e-commerce players has already been reacting by like shifting their plantation outside of China, or like having a local inventory, which means like there'll be less goods taking the air freight from this year onwards. Yeah, so instead like they'll redirect it to the sea freight. Yeah, so we do anticipate that will affect the growth rate for SATS cargo business, especially like US cargo business is accounting for more than like 25% of the group's total revenue. Yeah, so we do believe the impact on their bottom line is going to be around like at least mid-single digit. Yeah, so that's why we give a lower target price for SATS. Yeah, but their third quarter result was still good. Yeah, hope it answers your question. And so what is the fundamental view on accelerate and also capital DC? Yeah, so for accelerate, their FY24 DPU increased by around 0.3%. And yeah, and looking ahead, we believe like the positive rental reversion is very much likely to continue. But it's going to be at a moderate pace compared to FY24. And management is guiding to mid to high single digit rental reversion. And the list signed during COVID period are gradually like has been marked to market. That's why the rental reversion is not as high as before. And the leasing activities in the US and Australia is also expected to remain like muted. Yeah, as the occupiers is actually like taking longer time to commit the space. And US business parks, the segment continue to experience high like negative net absorption. Yeah, so and Australia, there's also like severe flight to quality trend, and the incentives has been creeping up. Yeah, that's for accelerate. And for capital DC, some update is like they recently announced a divestment in Germany, and then it's around 70 million Sing. Yeah, and the divestment is at 28% above its premium. But we do believe like significant capex will be required to refurbish the asset, yeah, before securing the new tenant. Yeah, so there will be like some downtime for the property. Yeah, but their FY24 result was very good. Rental reversion was like 39%. Yeah, if I remember correctly, but mainly like contributing by the Singapore side. And they do anticipate the high rental reversion will continue this financial year. Yeah, so should be around like 20-ish, 20 to 30-ish positive range. Hope it answers your question. And wait, I'm sorry. And also take on CEO forthcoming result. When's the date of the announcement? So the announcement should be 6 March. At least like our briefing is 6 March. Yeah, so we'll update afterwards. And we do expect the result to be good, like especially when Shanghai Pudong International Airport, like international air traffic increased like at least by 100% year on year. Yeah, so we do believe our PATMI would be around like 75 million this year. Yeah, but they'll have some one-off expense, yeah, to be added into the operating expense. Yeah, so that's mainly going to be the thing hurting their PATMI in FY24. But and they're very likely to keep this current dividend policy of 30%, and there will be no special dividend this year. Yeah, that's what we are anticipating. Yeah, I already answered the SATS question. Yeah, that's all for me. I'll hand it over to Paul, probably. Yeah, thank you. Oh, sorry, there's a Paragon rate. You saw some Paragon rate privatization, or should investors sell out at 98 cents? Yeah, our recommendation is to take the offer, like citing the previous Fraser Hospitality Trust example. Yeah, so they offer the price at 1.07 times of their net asset value. Yeah, and the share price actually increased by around like 40% after the announcement. Yeah, but then since the privatization offer actually like rejected by unit holders. Yeah, so the share price decreased by more than like 24%. Yeah, so we do we just do recommend unit holders to take it. Yeah, especially they are having the reason is like they are undertaking a major AEI, which is going to be like 300 to 600 million. Downtime should be around like it's taking 2 to 3 years to complete without adding additional GFA into it. Yeah, hope it answers your question. Yeah, that's all for me. I'll hand over to Paul, probably. Thank you.
Yeah, thanks, Ma'am. Yeah, sorry, I was in the Raffles Medical call, so I couldn't take some of the I couldn't present, so apologize for that. Let me just try some. Hi, Paul. Any small mid-cap names you think could benefit from the XCX review? Okay, so for the XCX review, the details is not out, but on how they are going to farm this out and what will be the mandate given to the fund managers. But what they mentioned, our guess is that any fund manager that tries to get this 5 billion mandate won't just have a pure Singapore equities, because you're going to limit your ability to raise more money, because the one unknown is that whether once they farm out this 5 billion, is it just for 10 years? Usually they do this farming out, then they actually take back the money after 10 years. So, I mean, if you are a fund doing this, you probably want to have some ASEAN or regional exposure. So it could be maybe a small mid-cap fund exposure, and which is good enough for the Singapore market. And also, if you read the MAS guideline, they want it to be not focused so much on index-linked stocks. That means the large caps. So if you are assuming that the mandate will be for funds will submit a regional small mid-cap mandate, then it will be positive for all the mid-cap names here, because even if you put 1.5 billion over the small mid-cap here, which is less than 1 billion, about 25 billion, is still like a 6%. So imagine you're buying 6% of every company. So it's more than enough to move the market. So in terms of the names, one easy way to do is that if you go to the Catalyst Index, right? So Catalyst is supposed to be small cap. Some of the bigger names in Catalyst Index itself, which I think any typical fund manager will use that also as a hunting ground to sieve out, would be like Kimley, Unusual. I'm just reading out the names. It's not that we have any coverage. Kimley, Unusual, CNMC. So these will be some of the names that I think any fund manager will look at, because they're the largest of the small cap. And then they will also, of course, look at some of the coverage. Most funds won't go and start their own coverage. They will try to look at what is being covered by the existing brokers. So for us, the usual names that we have, I think you can go through our email. We cover quite a bit of small caps, can be Q&M, Alltech, I don't think BRC and Pan United considered they are mid caps. So these are some of the companies that we mentioned. Construction industry, marine, Pacific Radiance, and I think these are some of the small cap names that will be the top of mind of any fund manager. And just one last point of the review is that I think the ultimate aim, which the MAS is trying to do from reading what they mentioned, is to because there's no price discovery. If you're a small mid-cap name, I mean, nobody cares about you, and not only in Singapore but even globally. But if you can create a niche on the SGX for small mid-cap regional companies, because they know they can't get the proper valuations or price discovery, then it becomes a unique destination. Of course, if you're a national company in Indonesia, you're not going to come to Singapore at least. It's almost impossible. I mean, they won't let you do it. So it'll be more for small mid-cap names, that they think they can get better growth. And then you got better ecosystem here, you got research here, hopefully, and then and it's paid, they are subsidizing, and also you got funding here, and you got institutional investors here, which the MAS has provided. So I think that would be the uniqueness. Let me just move on. Hi, Paul, how is Starhub doing compared? So I think Starhub, I was just trying to double check, but I think compared to Singtel's mobile, I think Starhub revenue for mobile came down more than Singtel. For the mobile revenue year on year, price cutting and grab market share. of course, one view you can have it is that they are bulking up before a consolidation. I think you want to. Oh, sorry, I think my internet is a bit choppy. You want to bulk up, right? Before you go and before you go and consolidate or become the acquirer, you make yourself bigger. So that is one view. The other view is that M1 may not. Starhub may not be the acquirer. So what if maybe TPG or Simba is the acquirer? So if that happens, then it is actually positive for Starhub. I mean nobody knows, but that there is some. It does make some sense for Simba to also, because they don't have 5G, right? So if that happens, then of course it will be very positive for Starhub. Just one last point for Starhub. In the near term, the negative for us is that the competition looks like it's going to get worse. So that's why they didn't want to give a revenue guidance. But they're committing to their 6 cents, and they said that any savings, as you recall, they got this thing called the term the DARE Plus, which is just they're just spending a lot on IT, and so the benefits, the cost savings for these big investments that they did of almost 200 over million will only happen in FY26. So that's something to watch for. But it's a bit of there's a bit of binariness to the stock, because if they become the acquirer, then the stock will get knocked down. I mean, it's going to get hurt, because if you are the acquirer, then you get distracted, right? You have to spend time doing integration, then their other competitors might try to take the opportunity to take share from you. Then if you're an acquirer, you're definitely going to have some one-off costs, integration costs. You will probably have to optimize your headcount, try to consolidate your IT system, back office, and it's going to be very, very time consuming, very numbing, and you're going to make some write-offs. So there's a bit of binariness to Starhub share price, I mean, in my own view. Although we have accumulated based on valuations and all that. Okay, I'm trying to because the results, the next one is, will Sembcorp Industries be good? I think it will be modest growth, maybe low, high single digit. The growth will come because of the renewables business, because they got a few new renewables happening in Indonesia. But my pushback for Sembcorp Industry is just that the dividends, their dividends is really low. And you're supposed to be a utility company and you don't pay dividends, then what's the benefit of being utility? Because utility is supposed to be recurrent, stable, long visibility. They lock in contracts for 5 years, but then they're not paying anything attractive. So that's my only pushback for Sembcorp Industries. Okay, sorry, I'm just trying to, because there's some photographs on the questions. Paul, how do you read what has been reported Warren Buffett selling and holding cash? Again, I'm really not sure how to read that. I mean, obviously he thinks that the market is expensive. That's as much I can say. But sometimes he might be also holding back cash for some big acquisitions that he has in target. But in general, as you know, I mean, no one have to be a genius to know that the US market is expensive. They're facing a few headwinds. Market is expensive. Bond yields are rising, or at least the Federal Reserve is not going to support the market, because most likely the cut is only one or at most two. And then the third thing, the allure, the frenzy over AI is also dying off a bit. And then the final one, which I think economists, the thing that's starting to worry the market now is the whole Dodge thing. I mean, you can cut workers, it is a good thing, but at the same time, it could actually hurt the employment numbers and also hurt the US economy in the very near term. So there's a bit of worry how aggressive this Dodge is going to be if they keep on cutting. And of course, you got the whole tariff issues. So I think I'm not commenting on what Warren Buffett said, but I think there is a few negative headwinds for the US market. Yeah. The next one is how it's getting results. I think the results is weak. I think in general the results going to be weak, because the high roller business is pulling back, and also I think market could also start to worry about the whole Thailand, because the Thailand is getting some momentum in getting the legislation done for the casino. I think they passed a recent legislation. I think you can see it from the news. So of course we got no super insights. We normally try to go to their AGM and try and ask them, but because they don't let us into their analyst briefing because we don't cover them. But again, if you don't go for the briefing, how are we going to cover you? But anyway, yeah. So I guess we'll forever not be in the briefing. Yep. Okay. Let me move on to the next few questions. Paul, has Raffles Medical results bottom? Based on the core, yeah, I mean, it looks like he has bottom. The earnings that was better than we expected, and they mentioned that China is turning around faster than expected. So I think they definitely kind of bottom, and they also raised their dividend. These are all public news. They also just raised their dividend payout ratio to 50%. So I think it looks strong for Raffles, and for a hospital, usually hospitals trade at 30-40 times. I think they are trading probably high teens. So from a hospital perspective, they are cheap. What you expect for Nanoflame results? I don't think it will be strong because of Apple results. So Nanoflame is very dependent or maybe burdened on Apple volumes, and Apple volume is not turning up. Yeah, so I don't think it'll be strong, but we'll try and give you more updates. With the 2025 budget announcement to boost stock market, will this be positive for SGX stock price? Yeah, I think it's definitely a positive. I think the government is basically throwing money. I mean, holistically, the government is throwing money into the economy through to the consumers, through households, throwing money to the construction industry, throwing money to the stock market. So, and it can only be positive. You keep on throwing so much money. Yeah. I think that was the question. I think, yeah, but of course, 5 billion isn't going to move the needle for the whole stock market because it's only like 1% of the whole stock market, probably like 3-4 days of trading activity. But it's definitely going to be benefit for the small mid caps, which I think MAS is the good thing they did is to position it for small mid caps. Any prediction for AEM, Franken, UMS? I don't think the results will be good, except for even for Franken. I think GVT Grand Venture results will be strong. Franken results won't be good. It's more a timing thing because the year before. The interesting thing will be for AEM because if Intel really gets taken over, then we're not sure. No? Actually, it could be a positive, it could be a negative if Intel's foundry business were taken over. So will they continue using AEM's test equipment? Because Intel is obviously their major customer, so I'm not sure of that. So that one we need to update you. Right? We don't have this is a very new development, so we don't really have. Hi, did the SGX I guess you're talking about the equities market review meet your expectations? I think it beat my expectations. It obviously beat the market expectations. I think that's why the SGX share price bounced back up. I think the worry was that the government or the authorities was not going to put in any money into the equities market. And you've seen they've done it. And this is only tranche 1. So what could who knows what's going to happen in tranche 2? Maybe they get some feedback and who knows, they could even add more in tranche 2. I have no clue, but I think again this is only part 1 of this part 2 mini series, so it can only be a positive. I mean, yeah, it can't be a negative if they're going to do a part 2. Yeah, so that's why I think share price like SGX is all doing well. So it did beat my expectations. It beat my expectations in terms of the amount and also the holistic nature. They're not just looking at the stock market, is throwing money, but is to build an ecosystem around supporting small mid-cap regional companies listing on SGX. So I think that was. How do you view Propnex and Apex? Yeah, I think the earnings will be strong and I just that the earnings is coming out tomorrow, so I think the outlook will look strong. I mean, I'm a bit still puzzled why people still pay 2,700 per square foot at Toa Payoh, which is not Ardmore Park, but that's the thing, because everyone is looking at the absolute price of units. So I think it's a strong start. It should continue, especially if interest rates are continuing to come down. Yeah, but I just scratch my head. I mean, how you pay 2,700? Yeah. Any ideas with what venture lifestyle consumer tech consists of? Seems to be a drag. Our own guess is probably going to be the Philip Morris ICOS. And they are hurt because but okay, so there's 2 things for the ICOS. ICOS is also I think this public information is widely used in Russia too. So of course, what happened to Russia, they were also affected. So if actually, ironically, if there's a Ukraine deal, it might help them. And secondly, is that the ICOS, what happened is that they changed the way the filter is done. So it used to be a replacement used to be a big source of demand for the device. But right now, they changed the design. So as a result of that, there is no need to replace so much. The heating device, the ceramic, they remove the heating device. So because there was a free replacement. So if you have an ICOS, you go in and you say, I want to replace, my device is faulty. There was no questions asked, they will just replace. But that has gone away. So that was one part of the business that gone away. But just keep on monitoring because if ICOS, the heating part gets released in the US, then of course it's going to be a turbo charge for venture. So that's something to watch. Okay, for Riverstone, yeah, I'm not sure. I need to get back to you because I couldn't. I was in the middle of a few webinars. So I just that for Riverstone, I think there's a worry now that the China rubber. Oh, sorry. The question is, despite revenue and profit growth, Riverstone profit margin seems to be contracting. Is this a cause of concern? So what happened is that it started in Malaysia. I think Hatta Lega started to warn investors that the Chinese competition, because China can't sell into the US anymore, because it's 100% tariffs for gloves coming from China into the US. So apparently the China gloves is being dumped into the rest of the world. So I think that's hurting a lot of countries, a lot of manufacturers. But I need to get back to you. I'll try to do a film on the ground. Sorry, just that I was in between a lot of meetings, so I didn't have the time to listen in. Yeah, but I can get back to you and let me analyze deeper into the results. Yeah, sorry for that. Yeah. Hi, Propnex lawsuit, any impact on the counter? No, not really. I think even if it's a few 100,000, everybody will just put it as a one-off. The franchise, you know, when you do a new property launch, you usually only use 3 to 4 real estate agents. And you definitely use Propnex because they got 50% market share. Right? So if you don't use Propnex, now half your sales is not going to happen. So it's virtually an oligopoly. So all these things, one lawsuit not going to change the oligopoly. And because of the model in Singapore, I think most developers won't have their own big in-house sales team. How are you going to compete with Propnex? I think they got like 11,000 agents. If I'm not, don't hold me to the number. So no developer going to tell your 11,000 agents, I'm not going to use them. I mean, it's like almost suicide for the developer. Yeah, any idea when is the results? Semcon Industries will be on Wednesday, if I'm not mistaken. 27, on Thursday, sorry. Hi, Paul. US consumer sentiment down, inflation expectation up. Is that a red flag? I wouldn't. Consumer sentiment, I don't really use. I think that's my own personal view because it's very volatile. It's almost like reading newspaper headlines. So the sentiment is good and headlines bad. So I don't really look at it. But I think the worry now, the market worry, is the whole Dodge thing. Sorry to keep talking about this, but so there's there could be good things too because 60% of all US jobs come from the government. But if Dodge is freezing all new jobs and Dodge is cutting, the payroll numbers could look very bad, and that could give chance for Federal Reserve to cut rates. So I don't have an answer. I'm just telling you the dynamics only. I don't have the answer, but there's something to watch because if they really freeze, imagine no new jobs for government. And government-related sector is 60% of all the new jobs. I mean, the new jobs is just going to collapse. Because government sector, as in government jobs, social jobs, healthcare jobs, that is where the 60% come. So that's something for us to monitor. I don't have the answer. I'm not a US economist, but that's something that I'm also watching for. Does the new home sales number include HDB, BTO? No. So the home sales that we give you is normally excluding executive condo too, because executive condo is very lumpy. So if there's an executive condo launch, then it's going to make the number. But this is private sector new home sales. We even take out executive because executive, if it's lumpy, then you suddenly, why suddenly no sales? But executive, executive condo show sell out because it's like the big arbitrage, right? It's like a private residence disguised subsidized by the authorities. So like who doesn't want to buy an executive condo if you can qualify? What's your take on the Olam Agri stake? Yeah, I think is that will Olam give a special dividend? Yeah, I think they will definitely give a special dividend on this. It's like almost 100%. But part of it they're going to give pay down the debt. Just that I didn't have because today a lot of news and so I don't have the details. There's a 2:30 briefing. I think any investor can listen to it. It's on their website. So definitely going to be a dividend, and it's going to be a positive, obvious positive, because they are going to they sell the remaining 60 plus 60 plus % stake for, I think, almost 3 billion or 2 point something billion, and the market cap is only 4 billion, and after that they got another similar size OFI business inside Olam Agri. The one thing to note, the one thing to watch is how much of Olam Agri debt is included in the sale. I didn't have time to estimate. So as you know, Olam has, I think, 10 billion of debt, if I get my numbers correct. Don't hold me to it. So once you sell Olam Agri, like how much of that debt will go to Olam Agri's debt? So that's something to watch. If a lot of it, then you'll be very positive too. So just that I didn't have the time to calculate the numbers because they didn't really show very clearly on the slides. The numbers are flying all over. So that's something that I need to check. How does 1% increase in GST result? I really know. It's also economic activity. That's why corporate tax also jump up. So I'm not sure. I don't. So 1%, but if you do mathematically, like 1%, it's probably also around almost 7-8% by default. The balance 14% could be transactions, just the economic conditions. Yeah. But that is the number that we get from the authorities. Yeah. The GST, yeah. And property is also part of the GST also. Yeah. What are the positives to expected when the new 5 billion scheme by MAS kick in? I think I already mentioned it. So for that, just have to watch. So for us, we know the money is coming in. But the thing is, how much of it will go to small mid cap, and then so we just do not know how much goes to small mid cap. If you just go to the whole market, then no point. It's like a 5-day transaction here. But if it goes to the whole market, and then like how much of it, so that we're just watching for the details as well. But it's definitely going to be a positive for the small mid cap stocks here. Any negatives on this thing? It's just the quantum, we're not sure. And what other conditions are maybe the money is only for 2 years, then what's the point, right? After 2 years, whoever want to buy also, they not buy, he buy, then he need to sell tomorrow. So it is also how long will this 5 million? So we need to know the mandate, the conditions given by MAS to these fund managers. Be it the amount for of course, the other one is the family office. I think some estimate 15 billion, but I think that one a bit aggressive. You're not sure the family office. So you need to know the incremental jump, the incremental flow, because you're talking about the stock of family office, not the incremental increase. So that one is a hard number to compute. Yeah, because there's no such data for me to check on. Oh, when is the results announcement? Yeah, I think we did talk about it. Yeah. Okay. I think I've done most of the question affecting my part. Simba with 5G, I'm using that now. Yeah. But they might want to own the network. Yeah, because if you don't own the 5G network, then you forever have to rely on the Starhub and M1 joint venture. Yeah, because you don't own the network, so you're forever relying on them and also on their spectrum. Yeah, and they can, it's up to them to charge you too, in a way. Yeah, good to see you back. Yeah, thanks, CK. What's your view on Hoppa? The price is trending up. I don't have the results. I did go to a Hoppa briefing once in that AGM, and in the AGM, I think 90% of the questions was about asking the management to give some extra dividend. But of course, the management just ignore the investors. I mean, they just said that they're looking at investments. So I mean, there's a lot of deep value in Hoppa, but the thing is, whether are they going to give it out? And I think it is with the strong dividends coming from UOB, then obviously some of it will go back up to it. But if you want to buy Hoppa, unless they privatize it, maybe put some of the money. You must have to put some of the money in UOB. I do not know what's the dividend here. You're basically buying a much cheaper UOB stock, but whether can realize the value, I'm not very sure. That one, yeah, because they just ignore you, whether you want to pay, because I mean, these are the tycoons. I know they just ignore you. Yeah. Oh, okay. Yeah. Okay. Okay. Any thoughts on Marco Polo Marine? Okay. So for Polo Marine, I think the earnings were definitely going to jump because their big CSOV that was in the yard, which is starting to sail in March, but in the June quarter it may not contribute. Because this is their big, huge vessel that they spend money on, and it's going to be rented out to Vesta. So that will be the big revenue driver. I think the revenue is about 16 million a year. But the contribution will only come in the December quarter. Third quarter will start, but usually when you launch a new ship, right, there's always a bit of teething problem. So that will do well, and they are also launching a second CSOV. And demand for CSOV is still very strong because even though the US is not rolling out offshore wind, but Taiwan is doing it, Korea is doing it, Japan is all doing it. So the demand will still be good, and with the second CSOV, they can probably get better margins and better rental rates for it. So the outlook is good. Just that in the near term, because they were building this ship for the very first time, investors are very worried whether they can even get the ship done, whether can get customer. But no, as time goes on, I mean, Sean, the CEO, had done incredibly well to get this to complete it, to get customers for it. And the second one, they even get financing from the Taiwanese banks. Of course, not the Singapore banks. They've all been burned, all with scars on oil and gas. They're not going to lend you money anymore. Yeah. Yeah. Okay. Why is causing the Yang Zhejiang to crash today? I think, from what I understand, I think Trump administration has mentioned that those vessels built in China that come into the US will be charged certain tariffs. For if they carry the cargo on China ships, they will charge some tariffs. But I mean, I'm not sure how this is going to be effective. But I think, of course, that is going to be a worry for investors, and of course, worry for shipbuilders too. I mean, if I'm going to build a ship and I know Trump going to charge tariffs on me, so obviously there'll be some concern. When is Propnex results announcement? Should be, I think, to either late today or early tomorrow morning. Yeah, that should be the results. And don't forget that Propnex is having their anniversary, so my guess is they will definitely be paying a special dividend too. Yeah. My guess, I mean, they never, not that they whispered to me, but that's my thought. Paul, let me answer this last one before I hand over to Zain. Thomson Medical results very disappointing. How do you see the properties and how do you see them forward in 2 to 3 years? Yeah. Okay, so the disappointment in Malaysia, especially for them, was a bit nuanced. So because they lost out of 3 major insurers, they lost 2. And once you lose 2, the third guy is just going to ask you, okay, you want to keep me, you better give me a big discount. So I think of it as like a one-off disruption too. So how do I see them is that the oncology is key for them. I think oncology would be the big turnaround for them. So that will help Singapore and Malaysia. Vietnam won't contribute much because when the good and the bad thing about acquiring a hospital is that you're going to face a lot of interest expense. So the big thing for them will probably be next year when they start to sell some land parcels, because they need to get the plan for the hospital done this year. Then next year they can start selling some land parcels. So they have the land for the hospital, and they have land, and they have a lot of land left for sale. But you can't get the full value of the land if you don't have a plan on the hospitals. Otherwise, it's just bare land. So nobody's going to buy your bare land or give you less value. So all that will materialize next year, and then next year you probably see the turnaround in Malaysia, and then the ultimate aim is to have another big hospital in Indonesia. In Malaysia, Johor. Sorry, Indonesia is Raffles Medical. Sorry, yeah. Okay, yeah. So that is the thing. But the next 6 months or so, you don't expect the turnaround to be faster. But the circular change is oncology now is coming into their hospitals, which never happened before. And just look for the land to be sold next year. Yeah, not this year. It takes time, yeah, to catch the full value. Yeah. Yeah. I hope that answers. Sorry, I think I hand it over to Zain for the technicals. Yeah. Thanks everyone for your questions. Yeah. Sorry, I was. Yeah.
Yeah. Thanks, Paul, for taking the question. I'll cover the TA questions now. Yeah, share my screen. Yeah, so first up is on SATS, I think. That's the question. Does SATS look like a double bottom? I think I think personally for me, I think my view is that it's still likely to trend lower because we see it's still currently in a downtrend. Price is still quite resistant from all the short-term moving averages like the 5, 10, 20 MA. And then today, it made a new low actually below this 323 one, probably on the increasing volume as well. So I do expect price to continue trending lower. Perhaps towards the next support level is around $3.12. Then the next one is around close to $3. That's for SATS. Next one is on Singtel. For Singtel, I think currently it looks like there's a bit of weakness as price over here. I think Friday couldn't hold a retest of this $3.30 level. And then there was a bit of increasing volume as well. So I think maybe we could see a little bit of slight further pullback. Could do a bit of a range currently between like 320 to 330 about there. So the next support level could be around 319, 320, which was this swing low level. And then there was also there's also this trendline support over here as well. Okay, next one for semiconductor industry, I think it looks quite good. Recently, the price managed to break above this 567 level over here on the last Thursday and retested. I think there was a previous swing high close to 580. So over here, I think if you can hold a breakout of this 570 about that, I think we could still see a higher price ahead. And for Capital, I think for now, Capital looks still nothing much, just still sideways. I think still need to see whether price can break over 690, then perhaps it could go towards $7 and next resistance. But for now, I think just continue to trade sideways as it has done since mid-January. For Capital and Ascendas rate, I think it's also quite sideways, still facing resistance around 258. So I think still you see for price to break above this level, then perhaps the next resistance will likely be around 265, then followed by 270 about that. But for now, I think just sideways since November of last year. And next one is Mapletree Industrial Trust. This one looking a bit weaker, but for now still holding the support level over here at $2. But we'll expect some resistance around 210 about there, which was a recent breakdown level. So I do still think price action could be still weak for now. Maybe a bit of a sideways between that $2 to 210. Okay, the next one is Aztec Global. Yeah, for Aztec, I think generally has been a bit range bound, some resistance around 72 cents, but there was a last Tuesday above this downtrend resistance line, and then I think this is just consolidating over here right now. So yeah, I think maybe just a bit sideways around 72 cents for now, and then we see how it moves after the earnings. The next one is for Manulife BS REIT. So for this, I think we could still see a bit of a weakness for now. I think price is can't hold this 0.294 level, which was this prior resistance. Probably try to hold as support, but there was a weak bounce, and then following afterwards, I think last week there was a sell down to create a lower low. So I think with that, I think you come to this support level next 0.07 this area. So I do think that given this recent breakdown, price will still trend over. So the next lower support level could be maybe close to like 0.080, where there's also this trendline support that helped price in the past. Yeah, so still looking a bit weak for now. Then for ComfortDelGro, I think for now price might be doing a bit of a sideways consolidation. Price trend going a little bit down since for 142 breakdown over here, but there was quite a lot of support resistance here in the past, around 133 to 137 this area. So I expect price to hold a bit of a sideways in this area, in this price zone over here for now. Okay, next one I'll take some Hong Kong counters. First one is Meituan. I think for Meituan, generally it's still trading within this downtrend channel over here. But I think some positive recently is that price is holding above this 157. So this was previously support breakdown, then the resistance. Then over here, since mid-February, it's as a support. And then recently, test again last week, I think it's still going for a support with higher lows along the way. So I think as long as 157 can go, and if price tries to break above 170, then there's a chance that it could try to break outwards of this channel. Yeah. Next one is on Alibaba. So for Alibaba, I think currently broke above a resistance of 130, I think last week after the earnings. So if can hold above this level, I think there could still be some upside, maybe towards 150. There was this previously gap over here around November 2021. So that will be the next resistance level. But for now, I need to see whether it can hold above I think the 5-day moving average in blue over here, which is a very short-term bullish momentum we need to see. And also this 121, 130 area was like this swing high before price form a higher high. So I think it's important to see whether it can hold above this level first, then to gauge whether it can continue to form a new high in the short term. Next up is Tencent. For Tencent, I think currently it's doing a bit of a sideways consolidation at resistance level. So this 515, I think, was a previous support breakdown in June 2021. So it's a bit of sideways for now. But overall, I think we will likely still hold a bit of range between like this 480 previous swing high resistance. So probably between 480 to 515, this do a bit of sideways consolidation over here first. Next up is JD. I think JD looks interesting. For this one, it looks like potential breakout if you can break above 163 over here. So price formed a double bottom previously around 128 over here. And then now it's forming a build up this resistance. So that's positive. If price can break over 163, it's likely to come back to as this 190 swing high resistance over here. Okay, then for next one is for Hang Seng Tech General. And for the Hang Seng Tech Index, I think it's just gradually trending upwards for now. It's still very strong as price is still generally holding with above the 5 and 10-day moving averages. And as well as we can see, price broke above this 5,450 swing high resistance last week. And their backtest and continue hold as support. So I think with that, the bullish momentum is still very strong. As for now, 5,900 is a short-term resistance level over here, which was formed back in January 2022. Happens to be a range consolidation breakdown level as well. So over here might be some resistance might still take place over here. We might see a bit of a consolidation, but as long as price still holds above 5,450 level, I think still positive for higher price. Yeah, above 5,900, next resistance, I think close to maybe 6,150 about there for the Hang Seng Tech. The next one is the HST, which is the Lion OCBC HS Tech ETF. Okay, so this one, similar to just now, this one holding above the 89 cents breakout level over here. So next resistance for this, I think could test close to $1. Also a psychological level as well. That above $1 is $1.05. So I think still maintaining uptrend. For now, it's trading above the 5 and 10-day moving averages as well. Next one is the SRT, which is the CSOC IH S-REIT ETF. So for the S-REIT ETF, I think it's still nothing much going on for now. Just consolidating sideways between 70 cents to 73 cents for these ETFs. So I think nothing much has changed for now. The next question is some of the US names are NVIDIA, Microsoft, Alphabet, TSM. Yeah, so for NVIDIA, I think some short-term resistance is perhaps coming from this downwards resistance line over here, which would acted at 142. So we might see a bit of a sideways consolidation over here for now. Support is likely to hold above 130, this level over here. So maybe it might be just holding on here before the results in the middle of this week. And for Microsoft, I think Microsoft is just a bit of a just sideways movement, but some weakness as I think price is still under this blue color trendline support previously, and then we can see there was a very big bounce from that. 417 still holds as resistance with a bearish candlestick on a bit higher volume of Friday as well. So if it does breach below the recent swing of 405, I think we could see maybe some lower lows towards close to 399, this level over here. And for Alphabet also there's some weakness. Since price broke down this ascending triangle support at 192 after the results. We also seen some breakdowns of the support at 187 also last week. Last Friday, it broke below this 181 level. Over here, there's a gap. So I think price, we could see some short-term downside, further downside to fill out this gap and see whether this 174, 175 level will likely be the next support level in the short term. And for TSM, there's also some weakness in the short term. For TSM, price is still holding along this short-term downward support resistance line, and then price is still below 205, this level over here, which was a key level, given that this was a strong resistance in the past. Then you can see price was sideways over here, but continue to remain decisively under it for about a week and a half. So I think we could see maybe a slight further pullback to sort of retest this support level, the next key support level over here again at 192 in the short term. Okay, then some more US counters, Celsius, Lam Research, and ASML. For Celsius, I think after the earnings, there was a surge. Previously, it was trending downwards for a prolonged period of time. Over here, short near-term resistance, I think that will still likely to hold. The price will be, I think, at least $36 level. Yeah, then maybe we see a bit of a sideways consolidation afterwards, given this huge surge. Probably about 50%, I think about 50% in just a few days since the swing over here. And for Lam Research, I think Lam Research is still trying to gradually move upwards. So current price action, we've seen higher low since this end of December over here, and then price we can see is previously is holding above the $80 level over here, and last week broke above this $85 level as well. So this is a resistance. You can act as support over here. I think it will be positive for higher highs going forward. Next key resistance level will be this $99 to $100 level previously. And for ASML has a kind of similar kind of chart as compared to Lam Research, but it's a bit weaker. So ASML is just still kept in a range bound formation. Positive is that it's still holding about 720 previous resistance breakout, but resistance is still in this range at 780. So for now, I think it's just range bound unless price can get above 780. The next resistance level likely at 810 as well is 850. Okay, then back to some Singapore counters. First up is Seatrium. So for Seatrium, I think short term bit of selling after price broke below this short term very tight consolidation between 249 to 259. And after the results, we had a sell down with increased volume as well. So I think short term wise, we can also break down some of the short term moving averages. So I think in the short term, we could see some further downside to maybe retest this 230, 226 previous range breakout level over here. Then maybe see a bit of a bounce. The next one is Capital DC. So for capital T, I think it's just still kept in the range. Very strong support level still around this 209 level. And by price is still just upside is still kept along this downwards resistance line in the short term, which currently stands around $2.16 as a resistance. So I think maybe we still see a bit of a very range bound consolidation unless price can get above 216. Then perhaps the next key resistance is about 220 about there. So I think we still rather be still rather sideways in short term for capital Ds. For CICT, I think CICT is looking one of the better ones among the REITs. This one is looks like it's trying to keep a higher low over here. When it's testing this 196 resistance level. So I think if you can hold this higher low 193, 194, then perhaps there's a chance to try to make a higher high towards like 201 to 205 as the next resistance. Okay, next one is Wilmar. I think Wilmar is quite volatile in the short term. Price, I think there was a sell down back to this previous resistance level at around 310. Then there was a bit of rebound. So short term wise, it looks there might be some range bound that might take place for now. Resistance probably around mid 320s to about 330 this area. And then support will be this 310 about that. So maybe a bit of sideways consolidation. Okay, then some next one is Baidu. So for Baidu, I think it still looks like a sideways consolidation for now. Price back below this $91 level, this resistance, but still holding above this supports at H5. So maybe just a bit of sideways trading over here first. Yeah, as price was unable to decisively break above 91 and go upwards, continue the momentum. The next one is Ping An. I think I'm going to talk about this. For Ping An Insurance, okay, this one I think it's slowly trying to move upwards. Positive signs is that since over here at the break above $44, which was this breakdown level, price reclaim above this level and still forming a series of higher highs level. So we can see a bit of this trend channel over here taking place. Then as long as price remains above 44, I think it's still okay. We might see a gradual climb to try and test this 51, 52 resistance area over here again for Ping An. Okay, then there's a question, what's causing UOL to rally today? Is it the start of upward trending? Okay, for the TA portion, for UOL, looking at the chart, I think this one is just just gradually moving. There's a gradual downtrend over time since 2021. Today there was a spike, not sure why, but from the chart wise, there's a breakout of this downwards resistance line, and so as this range consolidation resistance around 520. So short-term resistance we could be looking at for now is around 545 area, as well as close to about 560 about that next. So you could maybe see some short-term spike, then move sideways afterwards. Okay, then I'll talk about the three banks. So here for the three banks, DBS, OCBC, UOB. So first up for DBS, I think price is still very nice. After the earnings was gap up, then price consolidated sideways, still finding 45 over here. Previous recent pattern support and move and bounce upwards. So the main trend is that it's trading within this upward channel in blue. So I think for now it's heading back to towards the channel resistance close to about 747. There might be some short-term resistance there again. But overall, the trend is still holding well for DBS. Then for UOB is not as strong as DBS. It's just after it's still moving a bit sideways over here. So I think let's see whether as long as this $38 recent breakout level prior to the earnings can still hold as a support, I think that will still be okay to maintain the short-term uptrend. Then for OCBC, something similar. OCBC is just moving sideways, but still holding above the recent breakout level of 1760. So that's still okay. And we see how it moves after the earnings. Okay, then I think there's one more TA question on Yangzijiang Shipbuilding. For Yangzijiang Shipbuilding, I think this counter is quite volatile. So today there's is breaking below this 310 resistance level, which for a long period of time over here. So then testing this 297. So I would think for today that this level at 297 should be able to hold. Yeah. So today the selling is quite strong as well, breaking below the 5, 10, 20 moving averages at one shot on increased volume as well. So I think for today this might be still the hold at 297, but for tomorrow, if there's a breakdown below this swing low of today, then we might see maybe it tests like 286 if it decides to continue the same momentum. So I think for now there's still some quite strong same momentum. Then resistance is like this 310 level for now. So that's my take for Yangzijiang. Okay. Okay, I think there's still some questions. Oiltech, Namchung, and Valuetronics. For Oiltech, I think uptrend is still very nice. Just trending along this upward support line, and price after the spike over here last Tuesday is a bit of it looks like a bit of consolidation on lower volume for now. So as long as price remains above like this 120, 123, 124 breakout level and this upward support line, I think for now the uptrend will still hold. It looks like a bit of a consolidation taking place right now. Then for Namchung also is quite similar. Price action wise previously broke above this around 50 cents resistance, just consolidating sideways. So it's now currently between about 51 cents to 55 cents about there. So just some sideways movement. As for Valuetronics, Valuetronics, this one is moving upwards gradually. Then reasons might come from this trend line over here. 67 cents might be a short-term reason. So maybe do another sideways again. Then support will be above 64 cents. Yeah, so that's. And for Co Engineering and Beng Kwang. Okay, Co Engineering, I think this one, after it tested this 0.048 level price, like it might be unable to hold this 0.043 level over here. So it might be a bit of go a bit deeper downwards. Support might be 0.041 from this upward support line. So this must hold for price to try to rebound upwards. If not, it might invalidate the breakout of 0.043. And for Beng Kwang, Beng Kwang, this one, I think previously was trending upwards nicely, above 25 cents breakout. But after taking the earnings, there was a sell down that actually broke this pattern over here. So it also broke below the previous build-up on support at 24 cents. So I think a bit bearish for now. Price we might see some further downside towards like this swing low towards 22 cents. Then it might do a bit of a range of consolidation. Okay, that's all for the TA question. I think I'll hand back time to my rest of my team for the other questions. Thanks.
Yeah, thanks, Zane. Let me just try and wrap up as much as I can. Share your meeting with Raffles Med now up 5 cents. So just to repeat, some of the positives that I got from the meeting is that volume seems to have recovered for them, patient volumes. There's an opportunity to raise price, and the thing is that the China hospitals are turning around faster than expected. So these were some of the key things. And they, of course, like I mentioned earlier, they also are raising their dividend payout ratio. Because I think after spending the last few years on their the 2 new hospitals in China, their capex requirements isn't as heavy anymore, and their net cash is about 300+ million. So that's why the outlook looks more positive. Any update on Jaffa privatization status? No new update, but just use 6 months from the time they announced the scheme of arrangements as the usual timeline to complete the delisting or the whole privatization effort. But there's really no news. Apart from our SGS review, other blue chip sector conglomerates benefit apart from the 3 banks. Not really from this. Of course, you can argue that the allocation to family office might help. But the one we can't really nail down the number. That was a big guess. It's a bit more speculative to try and guess the number. But that can also help at the margin. Yeah. What's causing the rally in UOL today? I'm not very sure. Actually, even some of the property companies are also rallying. I think some investors we talked to say that they're beginning to see some value in all these property stocks because the property price and transactions are actually picking up so much. But I think that's one view. People just taking a trading stance on property stocks because they're down so much and there's a rebound in property market. What's your view on Olam? I think Olam looks good even at this juncture because they still have one big asset they're going to sell and you're going to get that special dividend. But I don't think the result's going to be good. But anyway, everyone won't really look at the results anymore. They just look at the special dividend and also the next sale that they're trying to do, which is OFI. For that, it's probably going to be an IPO and then they might do distribution in specie. Yeah, that has been their plan at least. Yeah. But that one I don't think will happen this year because even if you look at the US, all the agri-tech, all the companies like the Archer Midland, Cargill, all that, they've not been doing well. Bungie, all that. So maybe it could be a next year thing rather or later of this year phenomenon. Okay, thanks everyone. I hope that helps. I think we can end the session. Thanks everyone for your time, for your questions, and I hope it was useful for you. Yeah. Thank you everybody and have a good week ahead. Yeah, thank you.